Welcome back to the deep dive. Today we're tackling something really fundamental to how European financial markets work, how they stay stable. EMR.
That's the European Market Infrastructure Regulation.
Yeah, exactly.
Mm.
And we're going to, dig into this based on the FinCrime intelligence material you shared with
Yeah,
us.
good source for this.
Our goal here really is to pull out the essentials, understand what EMIR actually is, why it's here, what it demands, how it's changing, and, this is interesting, find that maybe unexpected link to fighting financial crime.
Yeah, that connection isn't always obvious.
And we want to do this for you, the listener, trying to cut through some of the complexity.
Definitely. EMIR can seem dense, but understanding these core parts is pretty vital if you're involved in EU finance. It really shows how they try to build instability.
Okay, let's unpack it then. So, like most big regulations, there's usually a trigger, right? And for EMR, it seems pretty clear-cut.
Yeah.
2008, the financial crisis.
Oh, absolutely. The source material really nails this. The chaos in the over-the-counter derivatives market, OTC derivatives, that was a massive, massive problem back then. Huge instability.
Because it was so opaque, hard to see the risks.
Exactly. You had this enormous market, trillions involved, but it was largely hidden bilateral deals. Risks were building up, connected in ways nobody could fully track. That created, well, huge systemic vulnerability.
So EMI was the EU's answer.
It was their direct response,
Yeah.
post-crisis, designed specifically to bring transparency to that derivatives market and, crucially, to reduce the systemic risk, make it safer.
And this wasn't just the EU going it alone, was it? It plugged into a bigger international effort.
Precisely. It lines up very closely with what the G20 leaders committed to after the crisis and the standards set by the Financial Stability Board, the FSB. It was part of that global push to fix the system.
Okay, so that's the why. Let's get into the what. What does EMR actually make firms do? The source breaks it down into a few key pillars, doesn't it?
It does. The first big one is the clearing obligation. Basically, for certain types of standardized OTC derivatives, the more common ones, the rules say they have to be cleared through an authorized central counterparty, a CCP.
A CCP. Okay, and just so we're clear, what's the CCP actually doing there? It's not just watching, right?
No, its role is absolutely critical. The CCP effectively jumps into the middle of the trade. It becomes the buyer to every seller and the seller to every buyer.
Ah, okay, so it guarantees the deal.
Exactly. It guarantees the trade will complete even if one side defaults. By doing that, it breaks the direct link, the bilateral credit risk between the original two traders. That massively cuts down the risk of a domino effect if one firm fails.
Right, that makes sense. Central clearing for the standard stuff manages that contagion risk.
Okay.
Pillar one. What's next? The reporting obligation. This sounds like where the transparency really comes in.
It absolutely is. And this one's really broad. It says every single derivatives transaction, doesn't matter if it's OTC or traded on an exchange, every single one has to be reported.
Wow, every single one. Where does all that data end up?
It goes to a registered trade repository, a TR. And this is how regulators get that visibility we talked about. They can access detailed trade-by-trade data from across the whole market.
So they can actually see what's going on, like an X-ray?
Sort of, yeah. It lets them monitor market activity, see where risks might be building up, understand who's exposed to whom. It's fundamental for market oversight, something they just didn't have before 2008, not in this comprehensive way.
Okay, so clearing for standardized trades, reporting for everything, but not all derivatives can be centrally cleared, right? Some are too bespoke or unique.
Exactly. And that brings us to the third main pillar, risk mitigation techniques. For those OTC derivatives that aren't centrally cleared, EMR says firms still have to take specific steps to manage the risks between themselves.
Because there's no CCP guarantee in that case.
Precisely. You still have that direct counterparty risk.
So what kind of steps are we talking about? What does the source highlight?
Well, the key things mentioned are stuff like making sure trade confirmations happen quickly, basically, agreeing on the details right away. Then there's portfolio reconciliation, which means firms have to regularly check their books match up on the outstanding trades and their values.
Okay, keeping things aligned.
Yeah, and having clear dispute resolution processes if they don't align. And, crucially, the exchange of collateral. Margin, basically. Parties have to post collateral against potential losses if the other side goes bust.
Right, so posting assets as a kind of security deposit.
Pretty much. It's all about managing that direct risk when you don't have a CCP involved.
Seems like sensible plumbing, really.
Yeah.
And the source also mentioned general operational standards.
Yes, kind of underpinning everything else. This covers things like data quality, the reported data needs to be accurate, proper record keeping, reliable internal processes for reconciliation. The basics have to be solid for the whole system to work and for regulators to trust the data they're getting.
Makes sense. So who actually has to follow all these rules? Is it literally every company that touches a derivative?
Not quite everyone. Primarily, it applies to what EMIR calls financial counterparties, or FCs. So that's your banks, insurance companies, asset managers, investment firms, the usual suspects.
Okay.
But it also applies to non-financial counterparties, NFCs. Think large corporations using derivatives for hedging if their derivatives activity goes above certain thresholds. The idea is to capture those whose activities are large enough to potentially pose a risk to the system.
Got it. So it depends on the scale of activity for non-financial firms. Now, regulations like this rarely just sit there, do they? The source talks about EMR evolving, specifically EMIR refit back in 2019. What was the thinking behind that update?
Yeah, refit was important. The main goal was really about proportionality, trying to make the rules more practical and less burdensome, especially for the smaller players in the market.
Right, easing the load where it wasn't strictly needed for systemic stability.
Exactly. So one of the big changes was streamlining the clearing obligation, creating exemptions or simpler rules specifically for smaller financial counterparties, SFCs. They also clarified reporting rules to make life easier for NFCs, especially those with less activity.
Okay.
And they simplified things for derivatives trades happening just between companies within the same corporate group, intergroup transactions.
And did refit change anything about how regulators oversee all this?
Yes, it did. It beefed up the role of ESMA, the European Securities and Markets Authority. ESMA got more direct power to authorize and supervise the big infrastructure pieces, the CCPs, and the trade repositories right across the EU, working alongside the national regulators, of course, but giving ESMA that central coordinating role.
Okay. And looking even further ahead, the FinCrime intelligence piece mentions talk of EMIR 3.0. What's potentially coming down the track there?
Well, the proposals mentioned for EMI 3.0 seem focused on further strengthening how CCPs are supervised, also looking at tackling potential market fragmentation.
Which must be a bigger issue now post-Brexit.
Absolutely. The UK's departure is a key context there. And generally, boosting transparency, especially around derivatives activity that crosses borders, it's about keeping the framework robust as markets change.
Okay, now, this next bit I found particularly interesting. The source material spends some time on EMR's link to financial crime compliance, which, as you said, isn't the most obvious connection.
It's a really important angle, though, because while EMIR is fundamentally about market stability, about prudential risk,
Right.
the actual mechanisms it puts in place, they have significant knock-on effects for fighting financial crime, unexpected benefits almost.
So maybe first, how can derivatives even be used in financial crime? They seem so complex already.
Well, that complexity can actually be part of the appeal for criminals. They might use derivatives to, obscure who really owns assets, or to move value or risk across borders in ways that are really hard for authorities to follow.
Laundering money through layers of transactions.
Exactly. Making dirty money look clean by passing it through complex financial instruments. The structure itself can hide the origins or the destination of funds. It's a potential tool for that layering stage of money laundering.
So how does EMIR, designed for stability, end up hindering that?
It comes back to the transparency in the process because EMIR demands reporting on every trade and standardizes things like confirmations and record keeping. It shines a light into those complex structures.
Ah, okay. Less shadow to hide in.
Precisely. It makes it much harder to disguise illicit activity within the derivatives market. You've got data points being created. Who traded, what they traded, when, how much, how it was valued.
Creates a trail.
It really does. It enhances the traceability of everything, the counterparties, the trade events, and all that data flowing into the trade repositories. That's potential intelligence for regulators and financial intelligence units looking for suspicious patterns or investigating crime. It supports enforcement.
And presumably it forces firms themselves to have better controls internally.
Yeah, absolutely. To comply with EMIR, firms need robust internal systems for data, for risk management, for governance around their derivatives trading. And the FinCrime intelligence material makes a really critical point here.
Which is?
That firms subject to EMR basically have to make sure their internal compliance systems, their data governance, their operational risk setups, they need to be aligned to meet both EMIR rules and their separate anti-money laundering and counter-terrorist financing AML/ACTF
The
obligations.
systems need to talk to each other.
Or at least be compatible.
Yeah.
The kind of data quality, counterparty checks, and transaction monitoring needed for EMR often overlaps significantly with or directly supports what's needed for effective AML/CTF compliance. It forces a more joined-up approach internally.
That sounds like a massive integration challenge, but also a potential efficiency for compliance teams. Okay, who's actually policing all of this, making sure firms comply?
ESMA has that central oversight role we mentioned, especially for the CCPs and TRs and setting the detailed standards. But a lot of the day-to-day supervision of individual firms falls to the national competent authorities, the NCAs, in each EU member state. They work together with ESMA to apply the rules consistently.
And if firms get it wrong, what are the stakes?
Oh, they're high. Really high. You're looking at potentially very large regulatory fines, restrictions on their ability to trade derivatives, serious damage to their reputation, which can be crippling in finance, and in the worst cases, they could even lose their license or authorization to operate in the EU.
Wow, so this isn't just a nice to have. Getting EMIR compliance right is fundamental to staying in business for many firms.
Absolutely. For compliance teams, it means constant vigilance, ensuring reporting is accurate and on time, making sure all those risk mitigation techniques are properly documented and actually being followed, and having solid internal governance over the whole derivatives trading process. It's non-negotiable.
Okay, so bringing this all together, the source material really paints EMI as a cornerstone of EU financial regulation. Why is it seen as so strategically vital?
Because it directly tackles that core issue of systemic risk in a massive, complex market. It builds transparency, forces standardization where possible, and imposes discipline through risk mitigation. For any firm active in the EU markets or even dealing with EU counterparties, EMR compliance is just part of the essential plumbing for managing risk and operating soundly.
And its influence goes beyond the EU borders.
Yes, the sources do point that out. Because finance is so global, the approach EMIR took, particularly around clearing and reporting, has really served as a kind of benchmark. It's influenced how other countries have designed their own regulations for the derivatives market. It's a key piece in that global puzzle of financial stability coordination.
So let's recap quickly. We've seen EMIR born from the ashes of the 2008 crisis. We've unpacked its core demands: clearing, reporting, risk mitigation for non-cleared trades. We've seen how it's evolved through refit, with 3.0 potentially on the way. We've uncovered that really important, maybe underappreciated link to fighting financial crime through transparency. And we've touched on its significance as a global standard.
It really highlights how trying to fix one problem, market stability, can create tools and transparency that help address others, like illicit finance. That interconnectedness is key.
Yeah, that drive for better data and controls serves multiple critical goals. Okay, thinking about this whole journey, from EMI's start to its ongoing evolution, here's something to leave you, our listener, chewing on, based on what we've discussed from the source material. We know financial markets don't stand still, and regulations like EMIR have to adapt. We saw that with refit, and there are already proposals for 3.0. So how might this constant churn, this continuous adaptation of market infrastructure rules, actually impact the global fight against financial crime, a fight which, let's face it, is also constantly adapting and finding new avenues? Something to think about.